Howdy, Jacob here. Today we're looking at Elbit Systems, 10.6 billion market cap, slightly higher enterprise value in the aerospace and defense industry. They develop and supply a portfolio of airborne, land, and naval systems and products for defense, homeland security, and commercial aviation applications. Primarily, it's all over the place. So, globally, essentially, founded in 1966 out of Israel. Their revenue growth has been very impressive for a company that's been around for over half a century. 2.9, almost $3 billion in 2014 to almost $6 billion in 2023. So you're looking at about a 7% compound annual growth rate in revenue. Gross margin, however, is down and operating margin is down. So they're hitting top line a bit more than bottom line. I like companies that do the opposite. Maybe the revenue will go up double and their profits will triple, quadruple. That's what I like to see. Companies being more efficient, maybe selling off even the assets that aren't being efficient to fund and really make a lot of money. Really get a great return on the money invested in the business. And here we see return on invested capital declining from just about 9-10% to maybe 5-6-7%. With a dividend that hasn't been increased year over year, but is up almost double, maybe 70% or so from 2014. Balance sheet shows 198, a little over $200 million cash on hand with 652 million short-term debt, 384 million long-term debt. That's a lot of short-term debt for the cash they have on hand. R&D spend is a little under 10% of revenue, so still a good amount spending on money, taking away money from today to hopefully get more in the future and to become more efficient, which is what I'd want to see. Cash flow is 2023 negative free cash flow, 2022 barely any, but rolling 12 in 2021, very solid production of free cash flow. Their use of cash outside of a dividend that pays out somewhat substantial amount depending on the year is really just going to be acquisitions at this point. So I'm ready to make some assumptions here. Not the sexiest company I've ever seen, and so I'm definitely keeping that in mind. Revenue growth, assuming, recently a lot of their money is going to be going towards debt reduction because they have 600 million short-term debt in relation to 197 million cash on hand. So that's going to be troublesome for them. They're going to have to refinance that, and if not, you in trouble. Don't like to see that. And so that's going to likely dampen their growth. They're going to have to focus on that. I don't think revenue is going to be much greater than 4%. I think it's going to drop quite a bit. And I think that their margins, their free cash flows margins have been very ugly. I think I'm probably going to be looking at maybe 5 and 4.5%. Share change, 1% is 100 million. Stock-based compensation is nothing close to that. So keep it flat. I don't think this is a market average company. I think it's a below market average company. And I'm not raising that dividend because it's already fairly substantial in relation to their pretty wild sporadic earnings and free cash flow. Free cash flow specifically, which is going to be your lifeblood of the business. That's going to be cash in, cash out. That's how you fund those projects, like a dividend. And it's going to be tough to increase it too much more with the amount of debt they have on hand and light on cash. So for me, it's not really close to a buy at this price. I think there's way other more attractive companies that I would be doing more research in. And this is why sometimes it just takes 4 minutes to review a company. It doesn't have to take a super long time to realize it's just not right for you. Hope you enjoyed the video of yours today.